finance, what is the difference between commercial versus resi? I suppose what are the major differences, so we can, for somebody who's never got a commercial loan, it'd be great to talk to that.
Well, residential is just purely secured by residential property. It's, the banks look at your income versus your expense. Commercial, some part of it is like that. So commercial finance is obviously it's against commercial property, but there's for investors, for owner occupiers, equipment finance is technically commercial lending. Development would fall under commercial lending. Super funds, and the typical property type would be factory units, factories, industrial, office, and retail. And then there's like a bunch of other specialized securities like childcare and petrol stations, boarding houses, a bunch of other things. But it's a little bit more unique where it can be property based, where the lending is specifically LVR driven on property, or policies are driven purely by the property alone. So it's a little bit more like residential is very regulated, living expenses, how many dependents you have. Commercial is not quite like that. It's some of it is, but yeah, it's very different. And with today's climate, a lot of people are choosing the lease stock product we can go into, and that's just purely they don't even look at your income. They don't look at how many kids you have, what your living expenses are. It's purely based on the merit of the property. So,
what are we sort of what's special, or is there anything special around commercial finance and SMSF lending? What does that sort of look like?
It's pretty easy. Super fund lending. It's probably the easiest of all lending. But with the higher interest rates, borrowing capacity is just it's not as much as 12 months ago. So standard, the person, two PAYG clients, payslip, how much do you pay yourself super? You receive super, annualize that plus the rent equals how much you can borrow. So it's very simple. That's traditionally how all the lenders work, but there are some lenders where you could, if they want to buy a larger property, they can you can do an external serviceability. So you could say, okay, husband and wife are on 100K each. That's say $10,000 each in super, but they really need 20K each or 25K each. So you can do a serviceability assessment personally to say, okay, they've got that extra capacity to contribute more money. It's usually not so much because most people, when they're buying super, they've probably exhausted out their personal serviceability as a PAYG client. Self-employed, it's a little bit different because the self-employed business can actually rent from the super fund. So you can look at the whole business income and look at the rent that they were paying, add that back as non-recurring income. So there's a few more levers with self-employed clients as well. LVRs can go up to 80% commercial. I've never done one. The rates they start to get steep, and some lenders get a bit weird with locations, so at 80%. But its sweet spot, I see 70% or 65%. It's a tiered pricing, so depending on the client. I personally went 70, and traditionally most people go to P&I 30 years. You can do interest only, but most people just choose P&I, and no major bank plays in that space. It's all non-banks. So you actually need a broker to use these banks. The banks actually don't. A lot of these banks don't deal direct with clients.
Yeah. Nick, what interest rates are you seeing at the moment for self-managed super fund finance?
I think the last one I looked at the other day was about 7.5%. I think. So I think it was 7.5%, and then there's establishment fees, monthly fees, valuation fees. So it costs a bit of money, but once you do it, 30-year terms, no annual review. These are like home loans. It's purely 30 years P&I paid off the next 30 years. You can't. There is one lender that does offset for commercial and an 80% loan. It's pretty weird, but it's a very good product.
I think I might know that lender actually.
Yeah, like you mentioned, Nick, as well. most people have a pay down strategy for their self-managed super fund as well. And then there's some tax advantages as well. You can do additional contributions to save on tax. So most people's goal is to pay that off as quick as possible and then just have the income generating for itself there.
Yeah. Some people, they want to buy another property. So that's where the offset works. It doesn't mean it's the best product in market. So most people actually choose the lenders without offset, but there is no redraw. So once you pay your loan, you can't go in and redraw it back out. And when you refinance, you can't. You can refinance a super fund loan. It's a bit of a pain. You've got to get all your documents from when you did it originally and trust deeds and all that legal advice, but you can't increase your loan. So you can refinance it and like round it up to cover fees and charges, but you can't pay it back. So I always say to my clients, what's your long-term goal? Do you want to buy another property or do you want to just pay it down? Because if you want to buy another property, just be mindful you can't money into the loan because you can't get it back out. So that's what the offset product can work quite well.
Let's see. Somebody said, this is an interesting one. It's a bit detailed in the sense, or a bit sort of micro. Somebody said, when buying commercial property with an SMSF, why do some lenders want full history and docs while some keep it contained just in the SMSF? Is that because of their risk appetite? Like, what is the reason why their policy, or is it the borrower type, or what's the?
Oh, it depends. So, if they want to see a full history of like your income, your employment, because that's how you get paid your super. So I'm just talking purely based on existing, so brand new super funds that are set up, and then now you're showing serviceability from you personally through your retail super contributions to buy in the super fund. Some lenders, you still need to provide like an asset and liability position, your full details, financials. Yeah, you need to still provide it all, but in the background, they're only just looking at one calculator that looks at super plus rent and the loan. Unless you, like I mentioned in the example before, that you need to a bit of an exotic serviceability assessment to take out some extra serviceability to add to super, and that's what's a full assessment.
What are lenders' appetites? And I know it's case by case and all that sort of stuff, but typically, what do they think about office space? Are they is that really on the nose for as an asset class in commercial, or?
No, it's actually so office industrial is priority with the banks. They love it. Office is okay depending on the location. Retail, one particular major bank has, so when I was talking about the interest cover ratio before, offices and warehouses, 0.5 times the interest rate is how they assess it. With retail, 1.5 times. So it's 5% rate times by 1.5, 7.5. Some banks are 2 times the interest rate. And this is actual rate, interest only. So there's no P&I, and it's the physical rate. There's one particular bank, they've hit their major bank, hit their retail cap, or they just don't like it. You need to assess it at 3 times the rate. So if say the rate's 6% now, 3 times
18%.
6, that's the assessment rate. Your LVR is 30-40% if you're lucky. They've hit their cap, they don't want it. So,
yeah, crazy. So what are we looking at here, Philippe?
They are the highest LVR.
So what was that, Nick?
So that same lender actually has the highest LVR for industrial. So they like industrial. They're open for business. They just don't want retail.
Does that change as often as it does for resi policy? Like when I was resi policy would change for lenders every week. Like how often are they changing their appetite for each asset class?
The asset class policies haven't changed too much. It's just in this high interest rate environment, the way they assess serviceability, it's because they use actual rates with the interest cover as the buffer. Some lenders have actually added a little bit of extra buffer just to combat these times. So that's why you've got to just be on the tools and just be dealing with the banks every month just to keep on top of it.
So Belize, are you saying that if somebody came to you and wanted a 7% net yield, that you would sort of say that they're chasing the wrong thing? They're chasing cash flow for the wrong reason? Or what?
Yes and no. You can definitely buy 7% yielding properties. Most of the time, they're regional industrial. So you go to like the Rockhamptons and the Townsvilles and things like that. It's just the vacancy period that you need to balance. So like typically there, for instance, Rockhampton, you're probably looking at 1 to 3 year vacancy for an industrial property. Whereas say Brisbane, it's 1 to 3 months. So I'd argue that buying a 6% yielding one is much better in Brisbane than a 7% yielding one in Rockhampton, because you're going to get better rental increases because the property's in more demand, better capital growth, and lower periods of vacancy. So I'd argue your ROI is going to be much better long term. And as most residential investors know, if you can get capital growth as well, that's where you really maximize your returns. So there's nothing wrong with that. Funnily enough, in retail though, Jeff, some retail in regional areas is actually lower risk than capital cities, because if you buy on the main strip, there's no other main strips. That's where everyone walks down. The vacancies are stupidly tight. Like if you lose it, it might be vacant for 6 months, but then you get a tenant for the next 15 years. So you can get some really good, like reliable tenants in main strips in regional towns. But again, it's part of the due diligence. It's sending someone on the ground to look at the foot traffic, different times of days, how much cars are going through, what future developments are going on as well. So make sure they're not building a Westfields 1 street away or a couple of streets away that's going to destroy your foot traffic. So you've got to look at all that. Retail, it is a lot harder to get right. So don't just jump into it. If you're a first-time investor, I'd probably suggest kind of industrial, just because you get a bit more like for like. Like you can look at square meter rates. You don't have to worry about foot traffic and business success and all that type of stuff.
Yeah. Let's I'll throw this question out before I go back to Brian's question. This is Dermot. He said, what if you get it wrong? How do you get out or bounce back after spending a lifetime savings? I mean, I'll throw in a thought or two because this is a really interesting one. When you say spending a lifetime savings, I mean, if you're spending everything you have, I mean, maybe I've taken this question a bit too literally or a bit too liberally. But I think if you're putting that much money into a deal, I think you maybe need to take a step back and question if that's a deal that should be being done.
I think the point of the question, Jeff, is how do they make sure they don't make a mistake on number one? Because as I sort of mentioned as well, property number 2, number 3, number 4, pivot off that. There's no right answer. You've got to try to get it as right as best you can. I always tell people, don't try to get rich on the first property. Like, just buy the most boring property you can that ticks every single one of the Ausprop fundamentals, and then get that as the base. Because at least you know over the next 10 years you perform well. It's all the people that try to get rich quick. They try to do something fancy or a big development project and don't have the experience. Commercial comes with it more risk. Like you saw the due diligence reports, they're 90 pages long. Like there's a lot more things to get caught up on there. A lot more reward if you get it right. But there is one thing, and that's why most people start off with residential, because at least if you buy in a kind of a blue chip area, that's where you'll kind of protect yourself.
Easy. What do you think? How long is it going to take you to wrap up with the benefit to invest in commercial over resi?
I'll answer my question in regards to the actual property and cash flow, and then I want Nick to actually answer for what's the benefit of commercial lending over residential, because there's obviously some difference there. Commercial is basically better serviceability from my side, better cash flow, get the same capital growth, so you win on more factors. However, not sugarcoating, higher risk, need to know what you're doing. And as we heard from some of Nick's horror stories, it can go wrong as well.
And also probably the LVR as well, I suppose, is not typically, you're not going to get a 90% lend in.
So when you're starting out, you've got more kind of borrowing capacity with residential, assuming you've got the serviceability, because I'd rather go buy 390% loans versus 170% commercial. But again, it's case by case. It depends where you're at with your portfolio. But I'll let Nick answer that part, because that's probably going to be the advantages and disadvantages of commercial lending over resi.
In terms of just like benefits, what I see, it's not even lending related. It's true net rent. Like your rent is your rent. Your tenant pays all the outgoings except for maybe the roller door and the aircon. Everything's paid for. And it compounds over time, and quite a few residential properties, and my inbox is going off always with, this is broken, that's broken, you've got to fix this, you've got to do that. And then when I look at my rental statement at the end of every month, I'm like, I only got $50 for this month. Like, what the hell? Like, so the true net rent, you look at a lot of the most successful people, like ultra rich people, like they're not getting rich on residential properties. They own, industrial sites or they own commercial. So, like Steve said, 90% loans to start out with when you've got less capital. But, you read, for example, Steve McKnight's book, you buy residential, you sell down or get equity, and you buy commercial. And then commercial, when you're retired, you can get commercial. As long as you've got deposits, you can actually commercial lending at any time. You can be 100 years old and go do a lease doc. There's no issue. So, the flexibility of commercial lending, if you're the right client, like if you've got 50K, it's pretty difficult. But if you've sold your business, sold down some properties, and you want to just really build a future portfolio, you can definitely keep going.